We tend to imagine artificial intelligence as a weightless, frictionless force, a magical phenomenon of algorithms that live seamlessly in the cloud. But the hardware required to run modern AI models requires vast tracts of land, thousands of specialized servers, and massive cooling infrastructure. Consider Meta's Hyperion project. To support their computational needs, they are currently developing a staggering 4,000-acre data center campus, built from the ground up to house thousands of high-density server racks. Expanding artificial intelligence requires pouring concrete, laying industrial power lines, and erecting massive steel shells. It is one of the most resource-heavy industrial megaprojects in modern history. Building physical data centers filled with thousands of specialized graphic processing units, or GPUs, costs exponentially more than traditional software development. This chart visualizes Goldman Sachs's estimate for the industry's future. Between 2025 and 2030, hyperscalers will need to deploy roughly $5.3 trillion just to build out the required AI and data center infrastructure. Even the wealthiest technology companies on the planet generate only so much free cash flow. A multi-trillion-dollar physical build-out exceeds the cash reserves sitting on their balance sheets. To bridge these massive capital expenditure shortfalls, Silicon Valley is quietly securing the necessary funds from Wall Street. The technological race to build the smartest models has quietly transformed into a massive credit operation routed directly through global financial markets. Morgan Stanley forecasts technology companies will issue nearly $570 billion in AI-related debt in 2026 alone. We see this trend materializing right now. By the end of May 2026, roughly $236 billion had already been issued. The sheer size of individual financing rounds reflects this. Oracle has sought a $38 billion syndicated loan purely to finance new data centers. By utilizing corporate debt, the massive financial risks of the AI boom have been effectively exported from specialized venture capital firms into the investment-grade global bond market. Yet a large portion of this new infrastructure debt does not actually sit cleanly on the main public balance sheets of the tech giants. Instead, hyperscalers frequently utilize off-balance sheet financing, routing capital through isolated legal entities known as special purpose vehicles, or SPVs. Meta's agreement with the private credit firm Blue Owl serves as a prime example. They closed a $30 billion deal to fund data center construction entirely through one of these off-balance sheet SPV structures. The Bank for International Settlements specifically categorizes these exact financial structures as shadow borrowing, noting that they create opaque transmission channels for systemic risk. By relying heavily on private credit and SPVs, the industry effectively obscures the true total leverage driving the AI build-out from casual retail investors. Beyond major hyperscalers, a secondary market of highly leveraged neo-cloud startups is taking on billions in high-interest debt to compete in the computing space. In circular financing, hardware providers like NVIDIA take equity stakes in neo-cloud startups like CoreWeave, who then buy NVIDIA's hardware. When outside banks inject loans into this cycle, the neo-clouds pledge those purchased GPUs as their primary collateral. Unlike real estate, computing hardware faces rapid technological depreciation. A top-tier graphics processing unit can become entirely obsolete within just a few years. If the specific computer chips backing this debt lose their value before the short-term loans are fully repaid, these highly leveraged neoclouds will lack the collateral needed to refinance, risking cascading defaults. The ultimate bottleneck threatening this intricate financial machine is not market sentiment or chip design. It is the availability of physical electricity. The International Energy Agency projects that under their base case, global data center electricity use could reach 945 terawatt-hours by 2030. Upgrading local power grids takes years, and utility interconnection delays are severely throttling the industry's ability to turn new facilities on. This creates the threat of a maturity wall. A fully constructed data center sitting completely dark generates zero revenue, making it impossible for developers to service their short-term construction loans. Local power grid limitations are proving to be the most immediate, concrete threat to the $570 billion AI debt machine. The mounting leverage and hard physical constraints must be weighed against the undeniable structural commercial demand for enterprise computing solutions. Alphabet alone recently reported a massive cloud contract backlog, reaching roughly $460 billion, proving that corporations are genuinely willing to pay for this capacity. Officials at the Federal Reserve have noted that as these models integrate deeper into the economy, their resulting efficiency gains could accelerate economic growth and drive down marginal computing costs. The massive capital deployment we are seeing is not necessarily a guaranteed bubble, but it has undeniably rewired global risk transmission channels. Artificial intelligence may deliver on its technological promises, but every revolution has a ledger, and this one is being entirely underwritten by debt.